Assalamu alaikum. Dear student, let's discuss in a very short video ethics in SBR, how examiner test this topic. It's an extremely easy topic. You can easily score, if there's a 5 marks question, you can easily get 5 out of 5. What you really need to know, I'm just discussing these things in this small lecture. Ethics in SBR. Number one, you need to know the code of ethics and conduct, like objectivity. You need to make sure that one, you should not be biased. Second, there should not be a conflict of interest. Third, due to influence of others, your professional judgment, your business judgment should not be affected, because if due to undue influence of others, your professional judgment or business judgment is affected, then it means you are not following the objectivity. The second point is professional competence and due care. You have to be competent, means when you're providing services to your client, you need to have a really good, I would say, expertise on recent developments. Plus, with due diligence, you need to provide services to your client. So professional competence and due care means when you are providing services to your client, you must be having a really good command on the recent development. Let's say relating to, it could be relating to IAS, IFRS, or relating to any technology which you are using while providing the services, and the due diligence. Integrity, you have to be honest, straightforward. There should not be any ambiguity. Professional behavior, your behavior should look like a chartered accountant. Your behavior should be according to, let's say that you actually represent ACCA. Your behavior should not be simply something which raises question on the raises question on such a prestigious qualification of ACCA. So you have to behave professionally. You must look like that you are an ACCA. Confidentiality, you need to respect the confidentiality which you gain while working with someone. You're not supposed to disclose the confidential information unless until it is required by the law, it is required by the profession. You should not be disclosing confidentiality to, you should not disclose the confidential information to anyone. These are the 5 code of ethics and conduct, but obviously nobody will be asking an SBR explain these code of ethics and conduct. Actually, the main thing which they ask in SBR is the application of these code of ethics and conduct. So in SBR, you must watch for incentive and directors acting unethically. Why directors are acting unethically? Of course, because of the incentives. It could be, for example, profit related bonuses. For example, they are doing window dressings in order to get the bonus. Poor historic performance, there's a possibility that business is not performing well, and due to poor historic performance, there's a possibility some of the people, they're sitting at a top level, they might lose job. So in order to just secure their job, they might push you that you should go for window dressing, and with a little bit cosmetic in the financial statement, it should look like that everything is fine. New product and services, there's a possibility that uh, all the estimates relating to the new product and services, they're just, I would say, it's a wish list rather than they made the estimate on a reasonable grounds. Financing, in order to get financing, there's a possibility that books are manipulated. They look like really good so that they can get the financing, and there's a potential listing possibility also. For example, the business is a private business and you are going towards listing. Again, there's a possibility to, little bit manipulate the books and try to get the listing, which is not a good idea at all. Watch out for the threats. Advocacy, basically you are representing something. If you are an accountant, so you are representing your company as well as obviously ACCA. So you need to understand that also. self-interest. You need to make sure that your self-interest should not, you should not be doing something for yourself, because you are there to, let's say, work for the best, for the benefit of, let's say, owners, and the ultimate owners are the shareholders. So your self-interest should not create problems. Self-review, you need to check your work, whatever you have done. Intimidation, you need to make sure that, see, when you are working in an organization and let's say you're not sitting at a top level, let's say you are an accountant, assuming, then obviously intimidation will come from the top level. There's a greater chance that directors that give you, they threat you, that you may lose the job if you're not listening to them, and whatever accounting treatment they are saying, you need to follow that. You need to make sure that due to intimidation your work should not be affected. Another thing, you must be really good in that particular IAS and IFRS. You need to know the proper accounting treatment. So due to intimidation, you need to make sure that your work should not be affected. Familiarity, some of the people, what are they going to do? They will become very close to you, and just because of those close relationship, they may uh, try to, get the advantage from you. So you need to make sure this also. What are the popular issues? Revenue recognition. For example, uh, next year revenue organization has recognized in the current year just to increase the little bit profitability to get the bonus. So in that case, you have to have a really good command on IFRS 15, revenue from contracts with customers. For example, accounting policy, choices, treatment. Basically, preparer of financial statements, they need to make sure that organizations should follow the accounting policy which is best suited. For example, if I talk about investment property, we have two model. One is cost model, another is fair value model. Obviously, investment property must be, I would say, capped at fair value model. That is more logical. But when it comes to IE 16 property, plant and equipment, you are using a plant in the production department. You are not selling it. And also its value does not changes due to macroeconomic environment so much. There's no much volatility in the value of that plant. For that plant, if you're using cost model, that is acceptable. I would say that is more logical. Provisions. Earlier when IAS 37 was not there, people used to make big bath provision, journal provisions, but now it is not possible. So you need to make sure that whatever provision organization is recognized, it must be according to IAS 37. A related party transaction is a really big threat. IAS 24, there is a possibility due to related party transaction, transaction might not have occurred, might not have recorded at the fair values. Presentation of financial statement, there's a possibility that organization might try to represent the things in the financial statement how they want, rather than what IAS or IFRS says. So you have to make sure that you need to follow proper IAS and IFRS. Consequences. The user of financial statement will be misled, obviously. If you go for the window dressing, that obviously user of financial statement will be misled. They are going to make the wrong decision. Directors, you need to persuade the directors, you need to convince the director. uh, they will be facing a loss of reputation. It's not a loss of reputation only the directors. Obviously directors eventually they representing a company. If later on people come to know that organization has manipulated the books, one, the directors, they will lose the reputation. Second, obviously organization will lose the reputation as well, and there's a chance of penalties on the directors as well. For example, if there's a possibility that directors had no idea about that particular accounting treatment, and due to that someone has manipulated the books. If the directors say that we did not have the really good idea of that particular accounting treatment, then it raises the question on the competency of the directors. Second, if they have done, which is not a good thing, obviously. Second, if the directors have done deliberately, then it's a more serious issue. So basically, whenever in SBR question on ethics comes, normally what happens, there will be one senior who is going to in who will be threatening the junior accountant to follow the accounting treatment what the seniors are saying, otherwise he's going to lose the job. Why do they threat the accountant? Just obviously to show that their performance is good in order to get the bonus. In that case, obviously you need to make sure, one, you have to know the correct accounting treatment. Second, you need to make sure that intimidation should not affect your work, and you need to persuade the directors if we do the manipulation, what are the consequences. One, it will be misleading the user of financial statements. Another thing, reputation of the director as well as company reputation will be impaired, and there's a possibility of penalties on the directors. And so things like that normally they come in SBR. So whatever I've just explained within, I would say, 10 minutes, if you have an idea of this simple handout, then to be very honest, it will really help you when you will be solving the ethics question in SBR. So as I mentioned earlier, I don't want this lecture to be very long. So after watching this lecture, it will definitely help you to solve SBR ethics question in SBR. So I would say thank you very much for watching this lecture. And let me explain one more thing before I simply, I would say, conclude this lecture. There's one change in consolidation. What is that change? Basically, when there's a transaction between parent and associate, in case of parent and associate, we know that how do we eliminate unrealized profit on a stock? It could be unrealized profit on property, plant and equipment. So basically now they have simplified the accounting between parent and associate. What is that accounting? Either parent is selling goods to associate or associate is selling goods to parent. There will be only one double entry. It's a simple approach which you need to follow. Simply you need to debit the retained earning with unrealized profit, and debit the retained earnings, and credit investment in associate, no matter whoever is selling. Investment in associate. Either parent is selling to associate or associate is selling to parent. Now accounting has become very simple, and this simple approach is you just need to debit the retained earning, credit investment in associate. For example, associate has sold 100 million stock, costing 100 million stock to parent for 120 million. And let's say parent's holding is 30% and 40% stock is unsold. 40% stock is unsold. We know that unrealized profit is in remaining stock. So total unrealized profit, initially it was 20 million, but now only 40% is unsold. So one, I'm going to take 40%, then multiply by the parent's holding, which is 30%. So 20 multiplied by 40%, then 30, I'm getting 2.4. So even though associate has sold, there will be a debit and credit. The entry will be retained earning debit by 2.4. Investment in associate will be credited. Investment in associate will be credited. So it's a little change in consolidation. Let me explain again. No matter either the parent is selling to associate or associate is selling to parent, the entry will be retained earning debit, investment in associate credit. This is called simple approach. So this is a change in consolidation which you need to know. No matter whoever is selling, the entry is retained earning debit, investment in associate credit. So that is all from my side. I have covered in this within 15 minutes SBR, ethics in SBR, as well as a little change which has come in consolidation in associate and parent. So simply, thank you very much for watching this lecture. Have a nice life.